All right, traders, a very, very warm welcome. I am Devang Mehra, and this is the episode 3 of the Sniper Trading Entry series. I hope everyone's doing good today. And today I'm here to discuss something I like to call a magic pill to your trading journey. So I'm going to give you a formula which is going to help you so much because it has personally helped me so much. This formula, which I call the magic pill, is going to help you save tons of time. It's going to help you save tons of money in losses, and it's going to make you some good money. That is something I promise you after today's session. So make sure you watch this till the end. It's a special video I'm doing for you on the Sunday, so you can try it out in the markets, you can back test it, and then you can bring it out in the market from tomorrow, trading Monday. So before I get started, guys, like this video if you like our series that we're doing, and mention in the comment section below where are you from, what city do you belong to, because in the coming weeks we are planning to come to your city to host some seminars to train you all live in the market. So if you comment in this in the section below where are you from, we can plan our visits accordingly. So guys, let's get started. Number one, before I get started, you have to understand, why do we make losses in the market? Everyone talks about profits, but I'm here to give you the harsh reality why you make losses in the market. Number one, the reason why we make losses in the market is because we do not know how to survive. Every new trader that comes into the market, he thinks he's better than the rest. He knows everything, and he thinks he can beat, every other professional trader in this multi-billion-dollar industry. And the biggest mistake is that we, think that technical analysis works 100% of the time. Guys, you have to understand that there are hedge funds out there who spend millions of dollars on algorithm trading, high frequency trading. If technical analysis worked 100% of the time, don't you think they could have spent millions and millions of dollars to make billions of money every single day just because a stock is giving an ascending triangle breakout? So it's not something that works 100% of the time. That is the reason why your risk management becomes important. That is the reason why we tell you earn 6 out of 10 times. So that 6 times profit should be much more than the 4-time loss that you make. That's number one thing. So you have to know how to survive in the market. The best example, the live example I can give you is, so yesterday, Trump has lost the presidential elections, and Biden is supposed to take presidency in America in the coming weeks. So what can happen is, tomorrow when the markets open, we might get a gap up. And if we get a gap up, it's the harsh reality that on Mondays, when you get a gap up, markets will try to plunge down and give you some kind of a big profit booking. That's a big possibility. So tomorrow on Monday, you can make some big money in the market because you can have a very good trending day because of this news in the market. So let's say tomorrow earning 50,000 rupees is not going to be a big deal. Now, what happens is, when a normal trader, he earns 50,000 rupees, he becomes so happy about himself. And every single day, he has this psychology that he wants to earn 50,000 rupees every single day. And he doesn't want to settle below 50,000 rupees. So guys, understand this. This big trending day that I'm talking about will not happen every day. It's only 1 out of 10 days or 1 out of 15 days. So you have to get your psychology right. You have to get your emotional aspect of trading right. And you have to learn how to survive, not to earn big every single day, but to earn small bits and pieces in discipline. That's number one. Number two biggest mistake, and the last biggest mistake I want to talk about, is called the top-down analysis. So people do not like to do or put in homework, put in the effort in the market. Everyone thinks trading is a very easy way to make money in the markets, and that is why they don't do any homework. They don't study any charts. They just come into the market at 9:15 p.m. They look at the 15-minute time frame and just look for a resistance to be broken and trade accordingly. If the resistance breaks on a 15-minute chart, they buy. Guys, understand, this is the biggest mistake you can make. You have to understand the externals. You have to see the daily chart, you have to see the 1 hourly chart, and then according to the structure, you have to come to the 15-minute chart and decide what you want to do. These are some mistakes people do because they think trading is an easy money game. They want to come in the market, make money, but doing homework is the biggest, is the main thing in trading. Trading is very easy, but doing the homework, that is something which will back you up and help you survive in the market. So enough about me talking. Let's get started. If you make these mistakes, mention in the comment section below. I would love to hear them. And I'll tell me if you want to see more of such videos, and accordingly we will do that. So what is this formula? What is this magic pill I'm talking about? This magic pill is called the MAEE formula. I'm going to write it down for you. It's called the MAEE formula. This is not my works, number one. This is adapted from the work of Rayner from Trading with Rayner. I would like to give him full credit. Yeah, he's a very established Forex trader, and he's a very fine gentleman when it comes to trading. So I want to help people in our country to know about this concept. It's very, very powerful. If you know these four MAE if you know this formula, I'm promising you, you will save so much time in the market and help to make a lot of money. So let's get started, guys. MAE, the first alphabet of MAE is the M. M basically stands for your market structure. That's the most important thing when it comes to trading. M means market structure. What is a market structure? Market structure means, are you in an uptrend? Are you in a downtrend? Or are you in a sideways market? So you have to answer these questions when you trade every single day. So M, is the market in an uptrend? So if the market is in an uptrend, what do? You are only doing something that we call a buy on dip. We avoid to sell in the market. Do not use any indicators which say sell, because we are only going to use buy signals if the market structure is higher. If the market structure is down, if you are in a downtrend, we will use something called sell on rise. We will not be buying. This is the biggest mistake people make. They like to, because I know, see, indicators are not wrong, guys. Use indicators. But if you combine indicators with this concept, you will literally filter out your bad entries. So again, if you are in an uptrend, if the market structure is up, only buy on dips. If the market structure is down, only sell on rise. Don't buy. And if the market structure is sideways, then you are doing something that traders call scalping. You are not doing breakout trading. You are then only doing scalping, which is buy low, sell high, buy low, sell high, buy low, sell high. Please remember, this is the golden rule in trading. Market structure. Now, the thing is, people ask me, what is an uptrend? Is the uptrend markets going higher? It's not as simple as that. Market structure, when I say uptrend, I'll give you a simple trading language, what Dow theory tells you. So Dow theory tells you uptrend means something like this. This means that you are getting higher highs and you are getting something that we call higher lows. This is what we call a uptrend, number one. Again, I will explain it to you. Higher highs basically means this high is greater than this high. This high is greater than this high. This low is greater than this low. This low is greater than this low. So I hope you get an understanding of what I'm trying to tell you. Let me come to the examples of Nifty. If you see the examples of Nifty, you can see the uptrend. This was one high. This was a higher high. This was another higher high, another higher high, another higher high, another higher high. So you can see a sequence of higher highs being maintained. And if you see the lows, you can see a sequence of higher lows being maintained. This is what I call an uptrend in the market. I hope this is clear. So if you are in an uptrend, what do? Buy on dip. So you buy here, you buy here, you buy here. You do not go sell here. I hope this is clear. Now, what is a downtrend? Downtrend means the exact opposite. You get something like this. Downtrend means lower highs. The highs keep on becoming lower. The swing highs keep on becoming lower. And even the lows keep on becoming lower. So this is lower highs and lower lows. I can give you an example. A very good example of on Friday's trade would be Vinati Organics. If I look at the 15-minute intraday chart, you can see Vinati Organics. This is the 15-minute chart. You're getting this high. You can see the highs are becoming lower every single time. Lower high, lower high, lower high, lower high. And even the lows become lower lows, lower lows, lower lows, lower lows, lower lows. So this is called a downtrend. So what do you do in a downtrend? You are just going to sell on rise. On rise means that every rally, you are initiating a short. Is this clear? This is the basic idea of the market structure. I wanted to make this clear before I move on. Now that you know what the market structure is, now let's move on to the second piece of the formula, which is called the A. The A stands for nothing but area of value. What is an area of value? In simple technical terms, this is something we like to call support or resistance. Area of value means support or resistance. Now let us try to combine M and A. So in M, I told you if the market structure is up, right? If the market structure is up, what do we do? Buy on dip. Now the question is, what is the dip? Dip is nothing, but if you come to your support, then you are buying. As simple as that, guys. So if you are buying on dip, so this is what I'm trying to tell you. This, let's say this is my support trend line. So if the market structure is up, where do you buy? You are buying at the dip. Dip is nothing but at your support. As simple as that. If you are in a downtrend, and this is my resistance, that is the area of value. So if you are in a downtrend, what do we do? Sell on rise. What's the rise? What's the rally? Your rally is nothing but you try to find a short opportunity at the resistance. As simple as that, guys. I hope this M and A concept is clear. In your sideways market, it's very simple. In the sideways market, you buy at support, sell at resistance, buy at support, sell at resistance. You are scalping because these two levels are your areas of value. I hope this is clear. Now, finally, coming to the easy part of the trading is called the double E's. This formula was M, A, double E, correct? We have done about M, we have done about A. What is this double E? Double E stands for entry and exit. How do we take an entry and exit? Do I blindly buy support? So I told you buy at support. Do I blindly buy support? In my previous videos, I made it quite clear that you can't buy blindly at support. You have to wait for some kind of confirmation at support and then buy. A very, very simple example how to get this confirmation is nothing but by using for entry and exit something we like to call candlesticks. That's it. That's the formula. So just now to combine everything in this equation, this is the magic pill that I want you to use in your market. So now let me again entire define the formula. This is my trend line. The market structure is up. So what are we doing? We are not going short here. Why? The market structure is up. We are only going buy on dip on the market. Where are we buying? We are buying where? We are buying at the support, which is the area of value, which is the A in the formula. What is the entry? If at the support, you are getting something like a hammer candlestick. That is an entry trigger for you because that's a bullish candle. That's an entry. Where can you exit? If at the rally somewhere you are getting something like a bearish engulfing, something like a shooting star, that is where you are exiting the market. To give the inverse example, let's say we are in a downtrend in the market. So we are adopting something that we call a sell on rise. Where do we sell? We are selling on the resistance. Now we are not buying in the market because the overall trend in the market is down. And do we sell blindly into resistance? That's wrong. We probably want to wait for something like a shooting star candlestick or something like a bearish engulfing candlestick, some kind of candlestick to initiate that short at the resistance. The reason why we like to do this is because I'm telling you this so that you can have a very tight stop loss and a big target. Because if you are shorting at the resistance, your stop loss is hardly 1-2 points away. Your targets are open-ended. As simple as that. So let's look into some examples into this. I'll try to find some charts and we'll try to see this entire application in reality. You can use any charts to clear. This is a concept that is overall applicable in the market, whether you're a long-term investor or whether you are a trader, intraday trader. So you can use for your area of values, you can use your trend lines, you can use moving averages like 200 moving average or your 20 moving average. All these things are okay. So I'll take an example. I'll start with the 20 moving average. I'll start with the example of Nifty. This is my 20 moving average. So 20 moving average, if you're above the 20 MA, you are generally bullish. If you are below the 20 MA, you are bearish. So you can see in this example, now we are combining every concept. Right now, what is the market structure? You can see the market structure is bullish because Nifty is in a higher high and higher low formation. So I am going to only buy in this market. I will not look to short the market. That's number one. Where do I buy the market? At the area of value, which comes at the 20 moving average. Again, you can use 20 MA or even you can use the trend line. That's totally up to you how you want to define your area of value. So 20 MA is a region where I want to buy on the dip. Do I blindly buy this? No, I'm waiting for some candlestick entries. So something like this is a bullish engulfing, or you can say it's a hammer candlestick. You can see over here, it's a doji candlestick. So at the support, if you are getting these candlesticks, you are getting an indication you want to go long in the market. That's a place to enter. Where can you exit? You can exit somewhere over here when you get a bearish engulfing. So I have defined the formula for you, which is going to help you in the market to make some money. Let me show some examples on stocks so things become very clear. I look for the chart, some trending. I look at TCS. TCS is a very good example in this entire trade. Um, yeah, let's look at this example. So TCS, you can see now is in the range bound market. The reason is we are not able to make any higher highs. We are not able to make any higher lows. The lows and highs are in this range. So I've told you very well, when you are in a range bound market, you are not looking to break out. You are looking for scalping. So you are buying low, selling high. You are buying low and selling high. Where are you buying? At the support. Where are you selling? At the resistance. Do you blindly buy and sell there? No. We wait for some kind of a candlestick entry. So let's look deeper into the chart. Can I find some candlestick entry? You can see very well here at the support, there is a doji candlestick telling you to go long. So all the formula is satisfied. At the support, you can see again over here, a doji candlestick is formed, another area to go long at. At the resistance, you can see a dark cloud cover, or you can see a hanging man being formed. Another example would be something like this, a bearish harami at the resistance, a bearish engulfing at resistance, a doji at the resistance. So what I'm trying to say is use this formula, guys. It's going to help you save a lot of money in the market. Let's look at the one last example of Reliance Industries. And this is, I think this is one stock everyone loves to trade. So this is one example which you can easily identify. Everyone trades Reliance. So I'm again using that 20 moving average. You can see the trend is up. The reason is you are getting higher high formation and you are getting a higher low formation. So the market structure says I am bullish in the market, and the area of value is the support, whether it's the trend line, whether it's your 20 MA, that's totally up to you. So you're only buying in the market. So when you come down, you look for a buy entry. So at the 20 MA, when can you enter? On a candlestick pattern, you can see a bullish engulfing at the area of value. You can go long there. If you miss this entry, you can even go long here, because at the 20 MA, you get a support, you get a doji formation or entry on the support. That's another signal for you to go long. So that's the rule which I follow in the markets. It's a magic pill I want to give you in the markets. We can finally talk about one stock which is in a downtrend, because a lot of people want to go short in the market. Probably let's look at Yes Bank. Yes Bank, or let's say look at Vedanta. Vedanta is one stock which is predominantly in a very, very big downtrend. I think that's a very good example. This is satisfying both the cases, because in this big rally on Vedanta, you can see you are getting a high formation. So when things were bullish, you only buy on Vedanta. And what's the support? 20 MA becomes support. So you look to buy at the support, buy on dip market, buying at the area of value, buy at the hammer candlestick, buy at the doji candlestick, buy at the doji candlestick, buy at the bullish engulfing candlestick, etc., etc. If you want to use some other tools, so for example, instead of using 20 MA, you can use something like a 200 MA. These things are totally up to you. So if you look at the 200 MA and look at the long-term chart, so now for an investor point of view, you can see that Vedanta is now in a primary downtrend. So I'm looking at the chart from the last 4-5 year data, 2-3 years data. So we are below the 200 MA. So for a long-term investor, you are bearish. So if you are bearish, what do? The market structure is down. The reason is because you are getting lower highs, correct? And you are getting lower lows. So we are in a primary downtrend. So if the market structure is down, what do? You are only looking to sell in the market. You are not looking to buy. So we are not looking to buy over here, but we are looking to sell, because we are going to get the big momentum in the market. So if you are selling, where do you sell? At the area of value. So in this case, my area of value is the 200 MA. Or maybe if you don't want to do that, you can draw a trend line. Just draw a trend line on the chart. So things become very simple for you. You can draw something like this, a trend line. You can do anything. It's totally up to your imagination. So we are looking to short somewhere near the 200 MA. The reason we are shorting at the area of value is, again, because stop loss becomes very small, a little bit above the area of values, and your targets become very big. So if you short at the area of value, your stops are very, very small, targets are open-ended. I hope you understand that point of view. So do I blindly sell A? I do not blindly sell A. I look for the double E's, which is the entry and exit. So go zoom into the chart. you can see a bearish engulfing around resistance, you can go short here, having a very tight stop loss above the 200 MA. Another example would be something like this, another bearish engulfing at the resistance, put a stop loss above 200 MA and go short in the market. Another example is this, a bearish harami at the resistance, you can go short here, stop loss above the 200 MA, etc. So what I'm trying to tell you is, whether you are a day trader, if you are a day trader, then the 200 MA, you can use that on a 15-minute chart, but you can use 20 MA, you can use a 20, anything. Or you are a long-term investor, then also it's fine. You can open the daily chart. So whether you want to do daily charts or whether you want to use the same concept on 15-minute chart, that's totally up to you. But I want you all to incorporate the MAEE formula in your trading style, because that's going to help you make a lot of money. So if you like this video, guys, mention in the comment section below and give us a thumbs up. And if you're new to this channel, make sure you subscribe to this channel. So that's it for now, guys, and I'll see you tomorrow in the episode of TFA Talks.